Joining us is Marathon Asset Management CEO Bruce Richards. And I point that out because I was wondering if you were getting interested again, Bruce, in some of these failing Chinese property companies.
Thanks and great to see you.
Yeah, you too. Welcome.
China is red, and China's going to be in the red for the foreseeable future as far as we're concerned. All arrows are pointing negatively. Starts with deflation, and so deflation at the consumer price index and the producer price index, and lower growth and weaker retail sales is all what you're going to see from China. But specifically, as an investor, forget politics for a second. We avoid China at all costs because of not the political side, but the fact that as a creditor, you have no creditor rights. So after trading in and out of that years back,
I was going to say, did you learn that the hard way?
Several years ago, no, not the hard way, the easy way, as we came out of it fine. But as you're trading in and out of that, we rethought the position based upon where the political rift is, and more importantly, where the rift is going to be with respect to manufacturing. And you look at their import numbers, you look at their export numbers, all again red negative. And we invest in other parts of Asia, Australia, South Korea, Japan. But at this point, I think it's prudent for folks like us and your viewers to start to rethink how they're going to deploy capital in China. And it starts with deflation, but as creditors, it ends with you don't have the creditor rights.
Wow, so that's a hard no on China. What about the U.S.? You've been pretty, I would say, more negative than economist consensus on the outlook for the U.S. economy.
Well, first of all, I'd point out that the economists are wrong most of the time.
True.
But listen, it's the dog days of summer, and we've had the hottest summer on record. And it's not only the heat, but it's the consumer is hot. Yeah. And the consumer is hot. And we see that in retail sales this morning, up 0.7, which is a monster number. And we all know that consumer consumption is 68% of GDP. And so as long as the consumer is strong, the economy is going to be strong. And the one thing that I'm focused on as it relates to the strength of the consumer is not only jobs, but wages. And it's wages, baby, that we focus on, because wages up 5.5% year over year, when inflation's running around 3.5%, means people have more discretionary money in their pocketbook to be able to spend. And so we expect the financial conditions to tighten as the yield curve is inverted, as the Fed keeps rates higher for much, much longer than what the markets are expecting. And so that recession is coming, but it's down the line. And so are we a hard landing? No, we're not a hard landing. Are we a no landing? No, we're not a no landing. We're a soft landing. And we expect a soft landing pushed out a couple quarters because the consumer is so strong.
So at what point do rates get so restrictive that they can afford to start cutting in tiny increments?
Well, look at the Fed. Look at the Fed and what they've done with their balance sheet, which is take it down a little bit, but look more at Fitch and their downgrade, because that allowed the debt ceiling to be resolved and the debt ceiling to be erased in terms of the cap on the debt ceiling. And so the Treasury has then issued $1 trillion in treasuries. And since the debt ceiling has been raised, rates are up 50 basis points on 2-year notes, 5-year notes, 10-year notes, 30-year bonds, up 50 basis points.
You think that's Fitch?
And so I think that's all about supply, which is the result of removing the debt ceiling and the higher deficits. And look at this, the Congressional Budget Office. They're expecting by year 2033, 10 years from now, for our debt balances here at the U.S. government to double from about 25 trillion to 50 trillion. And that's about a 7% annual increase of debt being issued relative to a 2% or 3% growth rate. And so that gap is the deficit. And Fitch downgraded it because of these deficits. And so while I think the credit itself of the U.S. Treasuries are the best credit in the world by a lot, I do think that the supply considerations and the Fed are going to keep rates higher for longer. And that's what makes it the golden era of credit. We're getting paid the best rates of return on our credit book than we have in a generation, earning on our private loans 12 to 14%, equity-like returns for taking senior debt risk.